Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our April monthly market update. Before we begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. We hope to see many of you. We're expecting over 100 at our quarterly investment forum this Wednesday, where we'll no doubt be discussing many of these same issues. I want to congratulate Valerie Roque, Senior Financial Advisor. You received this announcement last week. We're very proud to have her here and proud of all of her accomplishments. Again, you should have received a note about this last week. So this would not be our hoodie of choice right now. Definitely not a lot going on at the moment. Instead, you may feel more like this. So let's talk a little bit about where we are so far year to date. After a very volatile 2022, where there were 46 trading days where the markets were up or down by more than 2%, only 2 thus far year to date, and the markets are broadly positive. So the Fed is kind of center stage still after a number of years of QE. There's been radical rate hikes, 9 now. We'll talk about that more in a second. And one of the casualties for, among other reasons, interest rate hikes is Silicon Valley Bank. So this is just a graph at how aggressive the Fed has been. Again, most recently, the 9th consecutive rate hike. There's difference of opinion about whether the Fed will raise in May or start to pause. We'll talk more about that in a second. But nonetheless, you can tell just an obviously aggressive Fed responding probably too late to inflation. We talked about this at the end of March monthly market update. Silicon Valley Bank was the 16th largest bank in the U.S., recently failed. There were a lot of issues involved. I know this is a busy slide, but in essence, they had mismatch assets where if they would have held them to maturity, they would have been fine. But because they were marked down and because there was a run on the bank, they had to be taken over. Now, the question are these high-profile bank failures like we saw in Silicon Valley Bank and Signature Bank, will there be more? Thus far, if you compare this, only 2 to compare to bank failures back in the 08-09 timeframe. So far, it seems like contagion has been avoided, but that's something that we're watching closely. The jobs number in March was okay, meaning it wasn't so hot that the Fed had more work to do. It also was, again, job gain, so that's overall good. 236,000 unemployment at 3.5. Wage growth clicked down a little bit at annualized 4.2%. So the consumer's driving the economy. This is a look at GDP after a contraction in the first half of the year, a mild expansion at the end. Again, because the consumer drives 70% of GDP, how they're faring matters. There's still a more likely than not chance of a recession in some shape or form this year. We'll see how that plays out and how much of a future recession the market's already priced in. This is just a look at the consumer. Again, 70% of the economy is consumer driven. What this shows you is some early signs of weakness with the consumer, meaning debt service because interest rates are up, has picked up. So about 10% of a household budget as opposed to much lower just a couple of years ago. And that excess savings that accumulated during COVID has been starting to burn off. And the expectation is that will be gone by mid-year. So inflation is down from peak. So the most recent read is at 5%. If we look at peak in June and we say that that was peak inflation, it's worth going back to 1926 to see what the markets did on average the next 12 months after peak inflation. And you'll see for stocks and bonds overall pretty positive. Again, if we peaked on inflation in June of the last year. And the Fed, we talked a second ago about the Fed is increased interest rates 9 consecutive times, could be 10 by the time the Fed meets in May. But if you think the Fed, which we do, is closer to the end than the beginning, this is a look at the average return in markets after 12 months after the last rate hike, going back to the early 90s. And what it shows you is that on average, stocks and bonds are pretty positive. So if we can get closer to nearing the end of the rate increasing cycle, doesn't have to decrease, just has to not hike anymore. This is pretty supportive of stocks and bonds. This is another interesting stat that shows when money markets are at high, what the 3-year stock market looks like after that. So in January 23, just under 5 trillion of assets. If we look again at the 3-year stock market performance after a peak, it's pretty positive. And this just looks at a much longer view, 97 years of the market, 71 positive, 26 negative, including last year. All of those negatives are positive, but again, on an almost 3-to-1 basis, markets are up more than they're down in frequency, and on a momentum basis, 2-to-1 up versus down. Now we're going to tackle a separate issue today that we're getting a lot of questions about, and that is ESG investing. So let's do some brief definitional kind of overview. ESG stands for environment, social, and governance. And the aims of this have some positives, environmental, social, and governance in terms of a score. But there's some weaknesses as well, and we'll talk about kind of our view of ESG overall. One of them is that much of the reporting about how a company measures on those areas, they report themselves. So greenwashing is kind of under the ESG heading, is an act of providing, meaning the companies, the public or investors, with misleading or outright false information about the environmental impact of a company's product and operations. The other part that it often doesn't cover is supply chain. So the parent company may buy a supply chain or be provided a supply chain. And so their ESG score doesn't carry that or doesn't take that into effect. This is a recent example with Elon Musk and ESG, where Tesla, which you would think on the environmental front would overall be positive, was removed from this ESG index, while others, oil and gas companies, as an example, were included. And so that tells you kind of one of the ironies of ESG is how subjective the measures are. Whose version of E, S, and G, and how are they monitored? Not surprising, Musk, based on the information I just shared, is not a fan. He is a provocative figure, and he says, I'm increasingly convinced that corporate ESG is the devil incarnate. So that's obviously a strong and provocative opinion, but I think he highlights some of the, again, inherent subjectivity of ESG. So what is our approach? Well, I want to start with kind of the fiduciary standard that we are required to live under as it relates to allocating capital, in that at all times we are, as a fiduciary, obligated to act in our client's best interests. So with that in mind, with kind of the ESG framework, what is our view of ESG? When we allocate capital as a fiduciary in client's best interests, that allocated capital has to fulfill planning objectives. That capital has to be specific to a client, either profile or preferences or both, and those adjust over time. What we're trying to do with the allocation of capital is achieve the highest probability of success over the widest range of possible outcomes. And we have to allocate capital in a way that can be objectively measured with clear definitions. So our view, not surprisingly, as it relates to all of these factors on ESG, is that we're not allocating any capital today with the ESG framework. Again, it doesn't mean that all ESG objectives are bad. It simply means that they're not objective. They're subjective measures, and there's not an objective enough standard as it relates to who scores what on ESG. There's been a lot of marketing as it relates to ESG from investment companies. But again, we're not allocating any capital today based on that subjectivity. This is, I'll kind of finish here as it relates to ESG with a quote that says here, "These corporate sustainability goals are vague and totally unactionable. Well done." So again, I think this is kind of a way of describing the inherent subjectivity of ESG and why, again, at least as of now, we're not allocating any capital based on any ESG criteria. So you will be getting notes from us soon about an upcoming rebalance. You'll see in our trade notes kind of what themes that we're wanting to favor as it relates to market conditions now. We always encourage you to contact us. Videos like this and market updates are no substitute for talking to you directly about how all of these issues apply to you. So with that in mind, we'll close. Again, we want to thank you for the trust and confidence that you place in us. We hope to see many of you on Wednesday at our quarterly investment forum. Until we see you again, stay well and take care.